Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 25.58% year to date. We have a green for the stock market strength color signal. Our goal here at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. Their return on a percentage basis is 22.99% year to date, so we are accomplishing that goal. Last week, the S&P 500 gained 0.86% for the week. Now, this weekly candlestick chart has a duration of 5 years going back. And what we have on here is a negative divergence from the price action at this juncture here compared to the MACD. On the MACD, you've made lower highs going out this way, and on the price action, you've made higher highs. So that is a negative divergence, and it is a little bit concerning because it won't resolve itself until this black line here crosses above this blue line, indicating that it is breaking out. And it has not done that yet. And until that does that, it's not resolved. It is looking better because the MACD is above the signal line, which is the red line, but it hasn't quite resolved itself yet. So the concern is that the S&P 500 is just going to start tanking down and before it goes above this line right here. So there is a caution right there that we want to be concerned with. Last week, we made no trades. All right, here are all the trades I've made in calendar year 2024. We start the year off with $100,000, and we build the portfolio out from there. Currently, we are up 25.58%. And I do have one open position that was started on October 7th, where we did buy 200 shares of SPY, and we are profitable in that position, $2,628 or 2.3%. We've been in the position so far for 12 days. If you want to see how I trade this portfolio throughout the year, go ahead and smash that like button down, subscribe to my channel, and ring that bell to be notified when I post a new video. All right, here is our model portfolio in blue compared to the S&P 500 buy and hold investor in pink. Both portfolios are doing very well on the year-to-date returns. We are beating them by about 2 percentage points, but both portfolios have excellent returns so far this year. All right, now we are looking at a 6-month duration candlestick daily chart for the S&P 500. And here we've got that negative divergence showing up in the MACD from here to here with your price action, and on the MACD here. And I do have a concern that we're going to be pulling back about 4% soon. So I drew that in. I think we're going to go to these old highs here. So my prediction is in the not too distant future to pull back down to this 4% before it starts resuming up and coming up like that. So I kind of have a little bit of a prediction that I'm expecting that, but the price action on the charts is saying otherwise. The price action on the chart is just doing nothing but grinding up slowly. MACD is positive, slow stochastics is above 80. All these things are strong indications. Also look at your moving averages. I've got 3 exponential moving averages, the 813 and the 21. No, we're not even pulled into the moving averages. We're above the moving averages, no crossovers, bullish action. Now we're looking at a ratio chart from the NASDAQ 100 to the S&P 500. The ratio chart is the one that is in red and black. I also have on here in blue the S&P 500 and in black the NASDAQ 100. Now, a couple things I want to point out on this chart. Number one, The ratio chart is trading below the two moving averages. I've got a 50 and a 10 period moving average. We are below both of them. That's bearish. Number two, you'll notice that the black, which is the NASDAQ 100, this point compared to this point is heading down like this. That is a lower high. Whereas on the S&P 500, you'll notice that we made a higher high. From here, we went up. So that is a negative divergence from the NASDAQ 100 to the S&P 500. In normal bull markets, normally you're going to have the NASDAQ 100 beating the S&P 500. So when you see the NASDAQ 100 not making new highs and the S&P 500 is making new highs, that's a negative divergence. You're trading below your moving averages here on the ratio chart. Your MACD is below its signal line. Your slow stochastics is below its signal line, but it has bottomed and it looks like it's getting ready to shoot out. But so there are some concerns with what we're looking at on this chart right here. From this chart is generally speaking a bearish overall tone right now. Now we are looking at the VIX Volatility Fear Index. Below this line here, bullish. Below this line is the ultra low range. That's also bullish. And above this green line is the upper range, which is bearish. Currently, we're between the two green lines, so we're in the low range, and it is considered bullish. So your MACD is heading south. Your slow stochastics are heading south. All of these things are showing you that the market does not have fear. Its fear is dwindling down, and this is all bullish activity. Okay, now we're looking at things from a seasonality standpoint. And over here, we've got a 5-year seasonality chart. We're currently in the month of October. There is a 40% probability that you're going to close higher than when you opened the month. Well, if there's only a 40% probability of that, there is a 60% probability that you are going to close lower. Currently, for the month of October, we are up 1.89% for the S&P 500. That's this green candle right here. This is telling you that this candle at the end of the month should not be green and it should be red, meaning that from its current level, you're going to drop down and you're going to get something below this point, this line right here. This is where the candlestick opened, and this is where it currently is right now. So that is what the seasonality is telling you. From a seasonality standpoint, we are bearish. Okay, now we look on the ThinkSwim platform. This is a 3-year weekly candlestick chart for the S&P 500, and I have in here standard deviations of the +2, -2 in gold, +1, -1 in pink. And I drew in here a couple of scenarios in which my expectation of how we're going to do our trading. Now, there's a little bit going on here, but currently the current candle is right here. What I'll do is I'll pull off this Fibonacci so this way you can see that. Let me just remove that drawing. And here you can kind of see what the market action is telling you. But generally speaking, I mean, we're just grinding slowly up. You know, eventually we're going to have some type of a pullback here. Just don't know exactly when. Now, I do have cycle brackets that are here. So if I take this cycle low, theoretically, it should be coming right about now. And it hasn't shown its face yet. So, you know, is this low, that low right there? Or is it yet to be determined and we're running late? A little hard to say exactly what is happening here, but I can tell you that all we're doing is just slowly grinding higher. And that's what the market's doing. I have put in a couple of targets here, and I did want to say that my first target is 591.37. And if we do hit that, I'm going to take 50% off of the table. So this way we start banking some profits here. If we hit that second target, well, then we're going to totally protect the portfolio at that point in time. Let's switch over and look at things from a daily standpoint. So let's go to a 1-year daily, change our brackets to 1-year daily. And here, again, slowly grinding forward. Now, I do have a peak put in here where we're going to eventually peak and then start come down. And we're only like 1.5 percentage points away from there. So there's not too much more that I'm expecting to squeeze out of this before we have some type of a pullback. All right, here's a chart, an Excel chart that I created in order to determine the strength of different asset classes and the 11 sectors of the S&P 500. The more green on the screen that you see, the stronger everything is looking. We're going to compare last week's reading of 87 to this week's reading of 89 for asset classes, so things are looking strong, things are green. Also for the S&P 500 11 sectors, last week 88, this week 88, everything is strong. There's the market isn't giving an inch. It's also not gaining, but you know, these are strong numbers, 88%. So from this point, it's bullish. Now this is an interesting chart. This here is going to be the TNX, 10-year US Treasury yields. That is the candlestick chart. I also have the S&P 500 in dark blue right there. I also have TLT, 20-year bonds, which is in black right there. Now, I had a prediction that we were going to go from here to here. Well, I thought we were going to stop there, but it advanced to this line right here. And at that point in time, it hit a wall and came down, but it didn't come down much. It only came down to right here, which was that old high, before it found support and then bounced and came back up to this same line right there. Now, during the time that this happened with the 10-year US Treasury yields from here to here when it was rising, TLT completely took a bath during that time. But the S&P 500 from this point right here advanced and then started to go sideways and advanced some more, never gave ground. So where we are looking at right now with this chart, with the TLT being right there, with a TNX, 10-year yields being right there, I wonder if this is going to break out. Or is this line right here going to act as strong resistance, and now we're going to come down and go like this. Now, it's a little difficult to say exactly what the market is wanting to do because it didn't drop much and it went right back to that line. It looks like it actually wants to break out going that way. Is it going to do that? I can't call that. I don't know exactly what it's going to do, but I can tell you one thing. If it does do that, like this, that MACD, which is still above its signal line, is going to remain above its signal line and is going to go like that. The signal line will be over here. That action is very bullish action for this chart. That is a bullish activity if it were to do that. So this should probably unwind itself next week, and I'm going to be watching this closely to help me determine what's going to happen. Now, if this does break out like this, we know that TLT is going to continue to decline because that's exactly what it did when it advanced from here to here. TLT went down from there to there. So we know that if this breaks out, TLT will decline. Another question becomes, what will the S&P 500 do during that time frame? It's a little hard to say because the last time it went up, the S&P 500 also advanced. But as yields are going higher, it's supposed to be less attractive for equity investors such as the S&P 500. So at some point in time, it's the investor is going to say, the heck with investing in the S&P 500 when I can pick up guaranteed returns in some type of a money market or something like that and get my 5, 6, 7% or whatever the case may be. if this continues to go north. So this is going to be this is going to dictate kind of what is going to happen between TLT and SPY. So we definitely want to keep an eye on this. And what is this going to do next week? And how is this MACD going to resolve itself? Now, for us, if you want the S&P 500 to continue to advance up, you want this to hit the ceiling and you want this to come down. You want that to happen. And then this here would also come down and it would cross below its signal line, giving room for the S&P 500 to advance. So this is absolutely critical that we watch what happens to TNX next week, because this is going to strongly dictate what is going to happen to the S&P 500. Okay guys, that is going to come to the conclusion of this video. I gave you guys a ton of information. Now comes the critical thinking. What are we going to do with that information? Well, as of October 19th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now, the charts are telling me this market is strong, but I am concerned weakness is right around the corner. I feel confident that we are going to experience a 4% minimum pullback within the next 30 days. But this is just a gut feeling, as the charts say something else. I am going to hold my 200 shares for now, but I will be ready to put on this trade right here. We'll go through that in a second. If things start heading down, the trade is going to be 2 in-the-money covered calls with the strike of 562, which is about 4% lower than where we're currently at. And I'm only going to go out 2 weeks. I don't want a long duration. And this is a conservative trade with giving us 4% downside protection. Depending upon your feelings about the stock market, you could always take a lower strike price here if you felt we were going to experience a 6, 8, or 10% correction. You could do that and just give you that protection there. But this market, if it's going to continue to grind higher like this, well, you don't want to really be putting on in the money covered calls, because you're not going to be able to take advantage of that market gain if you're going to be taking on in the money covered calls. So we're going to just sit in holding our 200 shares for now. Let's wait till we see something watch that bond activity and see how that fares out next week. If that bond activity starts breaking out, well, I am probably going to be putting this trade on sooner rather than later, because that's when this market is going to absolutely crack. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.